My good friends, welcome. So we're looking at auditors' role in terms of reporting responsibilities to the management or those who are charged with governance of the organization. As an auditor, of course, you know at the end of the day, you've done your work. The shareholders will appoint you, okay, they nominate you or appoint you into that role. So you owe that duty of care or some kind of responsibility to report to the shareholders who appointed you. But you're actually working with the management. Is the management, the directors who give you the information, who run the show? At the end of the day, they are the ones you are going to audit them. So when we have finished our work, do we just report directly to shareholders? Yes, we'll do that. But of course, we also owe some kind of administrative responsibility in terms of relationship with the management to report to them on areas or things we have identified in course of the audit. We have to agree with them. Some of the things we have identified, if to our understanding, we think this is significant, but they are able to convince us that this is not significant, we tone it down. So there is a whole ISA on it, ISA 260, communication with those who are charged with governance of the organization. That's what we're coming to look at, okay? Once again, this is a summary. I'm not going to go deep, okay? When I share my slide in a second, you realize that the learning objectives are a lot. They are detailed, but I'm going to make this particular segment very short, and I'll focus on one key item, the management letter. So normally with the audit, there's a report which doesn't go out. It hardly goes out. It's called a management letter. Some call it letter of weakness. Some call it a service letter. There are a lot of names given to them, okay? Now, this letter or this document rarely comes out to the public domain. We don't find it. We don't see it, okay? Because it is more peculiar to the administrative or operational activities of the company, and it can contain very serious issues, okay? It hardly comes out. What we see is the published account. Normally, that document, from my perspective, I may not be right, is a neutral document, okay? It comes out and it really causes any havoc to the company. You see on just a snapshot or the performance of what the company has achieved over the years, their financials, their ratios, their CSRs. But there is this very sensitive letter called the management letter. It hasn't come out to the public domain. It is just restricted to the management and to the shareholders sometimes. And it even depends on your status as a shareholder. If you are a shareholder who is in the minority and you hardly attend AGMs or you rarely show interest in the operations of the company, yours is just to enjoy your dividend, you don't even get to see these letters. And we auditors ourselves, we don't divulge this sensitive document. It's quite sensitive. I remember working with in one of my audits, I almost mention the client's name, and there are some things which came up, and my audit manager asked me, are you sure you can defend these issues if it was presented in the court of law? If not, be careful you don't write something that will sabotage the image or the reputation of the company. Be careful. So sometimes we write a lot of things in our management letters, and you see our seniors or our directors, audit partners will sanitize this to be sure that we are not crucifying the client. Because as we said earlier, auditors, we are not bloodhounds, okay? We are not detectives going there to no, that's not our work. We are there as watchdogs for the principals. Okay, so there are things I will not touch on in terms of the learning objectives. I want you to take the text, okay, and read them yourselves. I will focus on one main item: communication with those charged with governance. Audit committee principles, I will leave that one. Research, you may have even come across it in your earlier studies. Read about them. Appreciate the problems of reporting where work carried out is done by another auditor, unconnected person. Read that one. I'll leave that one to research into that. I leave you to read those ones because you have to do more of the work in terms of you have over 260 hours of independent study. So that's a lot of work on your shoulders, okay? But it's easy. But the key ones I'll tell you. The key ones I'll tell you. When I say key ones, most likely because they are the areas you'll be assessed on, okay? I will not assess you on something I've not discussed in the videos or we've not treated in the tutorials, okay? We should appreciate the matters auditors may have to consider in addition to the systems of weakness. We'll look at that, and then look at the content of management letter. Timing implications for reporting. Make sure your reports is time relevant. You don't want to report on things which are far outdated. What importance will it give to the company? There is also the need for response by management. We'll look at that one. And the implications of the use of such letters in respect of third parties. I'll leave you to read on that one. I'll touch on it briefly. And then the last one, very important, learn how to draft a management letter. So you most likely find this in your final exams where we give you a case study. We want you to identify some weaknesses, possibly identify the cause of it. Try to link it to any criteria which you think may have been violated, any standard, any best practice. Identify the consequences of the weakness, and then recommend some corrective actions. And then that is it. Okay, all right, let's kickstart. So our objectives as auditors, like I said, we want to communicate with those who are charged with the governance of the organization. The directors, they prepare the financial statements. It is their financial statement we are going to audit. So we must clearly communicate with them. Let them know their responsibilities as management and our responsibilities as auditors over the financial statements. In this case, we tell them the timing of our work, the scope of our work, so that they know that we are working on ABCD and we are working within this time boundary. Our objectives as auditors is also to clearly communicate our audit process and let the management understand that the fact that we are adopting this audit process to review your financials does not preempt you, does not prevent you, the management, from preparing your accounts to reflect a true and fair view. It's not my responsibility. Mine is to express an opinion that what you have prepared and you thought it represents a true and fair view actually represents a true and fair view. So I'm going to do the audit, but don't rely on my audit to think that my audit actually is cleaning all the dirt on your papers, on your documents, and making it a clean sheet. No, it is your responsibility to make sure your financial statements represent a clean sheet, okay? My objective as an auditor is to also obtain all the relevant information from these managers and directors. They must give me the information to underpin the opinion that I will express. My responsibility as an auditor, or my objective as an auditor, is also to provide this management, the directors, those charged with governance of the organization, with timely observations of some weaknesses I identified during my audit process, and also let them know that, friends, this is what I've identified in terms of your control systems. These are the consequences, and these are the actions you can take. And I expect you as managers or directors to respond to me, the steps you would take, whether even you agree with my findings, okay? And of course, audits should include a two-way communication. That is why it's unfortunate I'm not experiencing the face-to-face tutorial sessions with you. I would have really wished I can get that experience with you, give and take. Because sometimes I'm presenting the lecture. If it was a live lecture, some of the things I'm saying, somebody will say, I don't understand this. Can you explain it? But here, I just go on and rattle and speak. And I'm hoping and thinking that you fully understand. But I know, some of you, not all of you, just a few of you will still have questions in mind you would have wished to ask, but you cannot get opportunity to ask. Don't worry. Always play back. My email is there. Get in touch. Send me a note here and there, and I can always respond. There are some practicalities we should consider in terms of communication with these managers, okay, those charged with governance. Usually, some of the practical issues to discuss is we need to get a point of contact as a channel of communication. And I remember working with a KPMG auditing stand chart, for example. They gave us a point of contact, the financial controller or the finance director, one of them. So he's the main person. Then you go to him. You need anything on payroll, then he will direct you to this. You need something on marketing, he will direct you to this. You need something on loans, he will direct. So a key person is always important. Some of the practical issues is that the auditor's estimate of assessed risks, which have influenced the planning process of the audit, can be a practical issues to discuss. How the auditor works with the internal auditor in a very constructive but complementary manner is also one thing which will need to be considered, which you need to always plan ahead. Because sometimes the internal auditors think you are their senior. You are coming to show them what to do. And so sometimes they push back. Because we expect that ordinarily, the internal auditor would have picked up a lot of things so that when the external auditor comes in, it will be take off, just take checklists and go. So when the external auditor comes and identifies some serious items which the internal auditor may not have identified, if care is not taken, the management will ask the internal auditor, so what was your usefulness in the company? So if you're not careful, there could be some pushbacks. We need to always educate the management on the roles of the internal and then the external auditor. So there's always a communication issue there between the internal and the external auditor if care is not taken. Also, we need to look at the attitudes, the awareness of this management. What is the attitude towards fraud detection, fraud prevention? What is their how knowledgeable are they when it comes to issues of fraud, detecting fraud, possibility of fraud? How knowledgeable are they about the systems of internal control? And is it effective? Do they override it? Something we need to consider. Another practical issue we should look at is that there could be changes in accounting policies, corporate governance practices, exchange listing rules, some specific rules and regulations within the sector in which they operate. There could be changes over there. The question is, are there any problems which might arise in response to these changes? Other practical issues to look at: communication with previous auditors. If I'm the continuing auditor, that's okay. But if there's a past auditor, communicating with them, getting the information, sometimes you don't get the information you need from them. Problems could also be encountered during the audit. There are delays. You want the company, the client to give you a draft financial statement. It's taking them ages. You want them to give you some schedules to do your work. It's taking them days. You also have a timeline to work within. So they keep pushing back. Sometimes they bring you a schedule. The next time they say, sorry, that was a mistake. Use this one. So that you should encounter this. You will encounter this. Okay, so you should always make provisions for that. Timelines shortened, restrictions imposed by management. You don't get what you want. And also there could be practical issues with how management estimates that their company will continue into the foreseeable future period, the going concern status of the company. Are there any material errors and misstatements which we have uncovered during the audit, which will require management to correct? And if they are not going to correct it, that disagreement between us as auditors and then the management, what should happen? Should it lead us to modify our report? If these disagreements are significant, they are material and pervasive. Okay, but if they are not material and pervasive, maybe we can put in an except for. Okay, an except for this particular situation. All right, let's move on. So significant deficiencies could arise in internal controls. So ISA 265 tells us that we should always communicate these significant deficiencies in the internal control systems to the management. This is where the management letter comes in. Okay, this is where the management letter comes in. So we have this formal letter, which we normally present to managers or the directors, those charged with governance. And here we will tell them about controls which are existing. There are controls in the company. These controls exist. We are thinking that these controls will reduce the risk of material misstatements, or they will detect misstatements. but the controls are not working. So we tell them, you have control over payroll. It's not working. Or we tell them that there are no controls at all over payroll. So try and institute some controls. That we are not the ones going to design accounting systems or internal control systems for them. We are not the ones, but we'll let them know, okay? That's a different work altogether, okay? Usually on these letters, the management and then the auditor will agree. If I'm writing something which may lead to different interpretations altogether, we need to agree. We want to deal with fact findings and figures, not feelings, okay? So this significant deficiency, like I said, we will describe it, we'll tell you the effect on the company's operation, we'll tell you the purpose of our audit is not to define or redesign the financial systems. However, items we have identified these during the audit, we'll let you know. But remember, not all the findings during the audit are possible problems. Sometimes they are minor, they are weak, very, very tiny items. You don't have to worry your head about them. You must report the significant ones to the management, not the tiny ones, okay? And make sure you report this on a timely basis. So the timeliness is very important. If you realize weaknesses in the payroll system during your interim audit, don't wait till the final audit stage before you report it. If you did some cash count, surprise cash count during the interim audit, the mid-year audit, don't wait and say, well, at the final audit, I'm going to report. Report whatever you find on a timely basis. Discuss it with the client and issue it officially. Sometimes we discuss this unofficially with them because we have the draft we discuss with them. And after we have put everything together in a written form, we agree with them on these issues. Very important. Management letters has many names. Letter of weakness tells you that it is actually tailored at identifying the weaknesses. Recently, I have seen some management letters which do not only focus on the weaknesses, but they also highlight some positives of what the company is doing. Very good. Okay, give them a tap on their shoulder and then chastise them where you have to chastise them. It's also called internal control memorandum, letter of recommendation, construction service letter. The objective is the same. They are telling us that there is a problem. It was caused by this. It violates this criteria. It will lead to this. Correct it. Same. Okay. Same. So it's a formal letter. We address it to management after we've completed our work, whatever stage of the audit. It is also a matter of courtesy that between the management and the auditor, we agree. We're dealing with facts. We are dealing with figures, findings, principles. Okay. It's quite detailed and it makes you get yourselves immersed into the operations of the company. Management is asked to acknowledge the receipt of this letter and they must officially reply. So usually when I work with World Vision, we extended this management letter extensively, but most companies, most audit firms have just four or three, I think 4. Some will go for 3. If you take this book, they limited it to 3 dimensions. I like the 5. I will say 5. Go for 5. Now, let me see if I have it in the next place. Okay, let's deal with this section 5. The purpose is number 1. I have not captured everything here, but I'm going to speak it offhand. Number 1, we must look at significant deficiencies. Okay, we don't want to deal with the minor ones, those which are not significant. Number 1, what is the condition? The first C, condition. In other words, you must mention the significant deficiency. Number 2, before you even make suggestions for improvements. Number 2, you've identified the condition. What caused it? Okay, I can even put the cause on the 3rd one. So you find a condition, the C. Number 2, you find the criteria. Maybe it is violating IFRS 16, paragraph 4, or it is affecting, or it is violating the company's code. Okay, Companies Act 2006, Section 42.3. You mentioned it. The criteria. It makes the client understand that you know what you are writing. You are talking of fact and principle. Number 3, okay, so you find a condition 1, 2, the criteria it is violating. 3, what is causing it? The C, the third C is a cause. What is causing it? Somebody is not doing his work well, or controls are not working well. Or controls are there, but they are being overridden. There's collusion. What is causing it? Number 4, what is the consequence to the company? The 4th C is a consequence. So what is the adverse effect it will have on the company? Clearly stated, okay? And then number 5, the 5th C is the corrective action. Corrective action, that's the recommendation, okay? So provide a feasible recommendation. So you highlight suggestions for improvements, okay? And then you clearly underline that this is what you guys must do. Point out those areas for management's attention, and management must respond to this letter, okay? Finally, let's wrap up. So clearly distinguish that the management letter is different from that of the auditor's report. The auditor's report, we see it in the publications online. Management letter is different. 2 different things. Our audit plan should include the preparation of the management letter, and we must always review actions management took on our previous management letter. Whenever we finish this audit report, we always leave a section, management action or management response. And when management has done it, they must even provide evidence that they have corrected this and send it to the auditor to review and say that it is adequate. It must be closed off. Otherwise, you have open audit recommendations lying down and that has not been resolved. In working with USAID, we had a lot of open audit recommendations, and as an audit control officer, I need to go on to the field to help them close off these open audit recommendations. If the deficiencies are not material enough, just discuss it with them informally. No need to write. And make sure whatever you do is in line with ISA 260, okay? Specific requirements set out. Now, a notable misapprehension is that the management letter can absolve. Listen to this. A notable misunderstanding is that the management letter can absolve the auditors from blame, and hence a legal responsibility to pay for any losses which flow from any deficiencies in internal control. No, that doesn't absolve you. You must do your work well as an auditor. The fact that, well, I saw this and told them, that's not enough. You must do your work to have a clean sheet, okay? If a significant deficiency is discovered by the auditors and they are unable to satisfy themselves to that extent, what do? If you have to qualify the account, qualify the account. If you have to pull out of the audit, pull out of the audit. If you can't rely on the records, tell them I can't rely on this. It's not enough for us to write that, well, I put it in the management letter, so let me just qualify it. Oh, qualify the account and be free. All right, we end here, friends. A question on page 446, Dunbar Manufacturing, self-testing questions are there, and then there's an ACCA pass question. I think there are 2. Yeah, 2 pass questions there. So you can see the Equestrian Company, and then there's another question on Amersham Limited. Very good ones. You will be tested on how to write draft a management letter. You will be tested on it, okay? So I've actually spent a little time. I should have just wrapped this up in 15 minutes, but I left it. It's very important. If you call yourself an auditor and you cannot draft a management letter, you are not an auditor. You should learn how to draft it. Okay, audit, your work is to write. Your work is to write. I'll leave it here. I'll see you in the next session. Bye for now.